Hello and welcome to another video on my YouTube channel. My name is Joris and today I am here with a video about what investors need to know about CCA. And you might wonder what CCA stands for because you didn't watch my previous videos, but CCA stands for Continuous or Consistent Cost Averaging or Periodic Investing. And you may know that consistent cost averaging is the term that I prefer, and it is a thing that we as investors should do all, but not many of us really do it. I personally do it because I invest 900 Swiss francs into our ETF portfolio every month, and every month I also invest 200 Swiss francs towards my U portfolio. And if you watch my previous videos, you may have already viewed my video about my dividend investing rules, and there you have the rule number 7. There is only CCA, and I start that slide with away with the term DCA. I don't want to offend people from America, but the term dollar cost averaging, it's just not covering everybody on the globe. It is covering the people in the USA, and some other people also have a dollar currency, but yeah, it's just annoying when you are living in Europe or somewhere else in Africa that you hear about dollar cost averaging and you can't relate to it because you don't have dollars. So I think it's better to name it consistent cost averaging, because that is really what it is. You need to be consistent in your contributions in order to get the benefit from investing into the market. And in order to be able to do that, you need to follow your budgeting and saving rules that you make up for yourself. And doing budgeting right is really important, because when you screw your calculations up, you are going to contribute too much in the beginning, and then you can't keep it up. You will get discouraged and you will stop with CCAing into the market. And then you have the luxury problem of lump sum investing. So when you get a lot of money in one go, or you saved a lot of money and then you want to start investing, you have the problem that you have the luxury problem that you have a huge amount to your disposal for investing, and you can decide to invest it outright. 70% of the time you will get it right. It won't matter whether or not you CC8 into the market or just outright invested it. And a good thing about that is that when you invest all your money from the get-go, you get that snowball rolling faster because you get more dividends. You can reinvest those dividends faster, and like this you accelerate your snowball the fastest. But you have negative points as well, and in that regard, you can underperform lump sum investing, because in 70% of the time it is better to just invest your total amount outright. That is true, but I'm always on the more careful side, and I always think about the 30% of the time that that's not the case. So in that case, I would CCA into the market, maybe invest over a certain amount of months, the double of the amount that you calculated with your budgeting, that you are able to invest every month. So when you are able to invest 200 euros, francs, dollars every month, you put in 400, and like this you eat away on the lump sum that you have to your disposal. Or you start with, when you have 10,000 Swiss francs to your disposal, you start with investing a lump sum of 5,000, and then the months thereafter you invest 700, 700, 700, so every time 500 francs more, until you are investing for 10 months. Then you have invested your 10,000 Swiss francs completely, and every month as well your 200 Swiss francs that you have to your disposal according to your budgeting. So for me, I'm always more careful, And in the beginning of this year, this strategy would have been the best because, yeah, Trump came along and threw the tariffs around like it's nothing, and the market, of course, is overreacting on that and it's going down. So when the market loses then 10% and you invested everything in the beginning of the year, you are already facing a huge loss of, okay, now the market already recovered, so now you would be at around 0% return. But would you have CC8 into the market and you put in 50% in the beginning, and then after it dropped 10%, you put in another 30-40% because you thought, hey, now it's way better to buy it. And then the 2 next months you invested the rest of the money, you would be up around 4.5% right now. So that's way better than investing the lump sum from the get-go in this year. But that's not always the case. So, but I'm going on too much about this point. And CCA, it does not eliminate all the risk. So we are still investing on the stock market, and the stock market is volatile after all. And you also need to realize that ETFs aren't equal to individual stocks. So when you CCA into one individual stock, you are not diversifying. An ETF, it follows an index. That index is normally diversified. You can also invest into indexes that are oriented towards a certain industry, and then you are still very concentrated because those industries, they, yeah, some are cyclical, and when you start investing into a cyclical branch of the industry that is going down on that moment of time, yeah, you are going to see your money go down time after time after time before the cycle goes up again for that branch of the industry. So you always need to keep that in mind. So for me, I would say if you want to start with CCA, pick a good global ETF. I have plenty of videos on my YouTube channel about that as well. I will put a link in the description down below of what I think is a really good video to start off with. And you also have to keep in mind that when you do CCA, that you are going to be faced with higher costs compared to a one-off lump sum investment. But I still think that even when you do a lump sum investment, you should continue with additional payments later on as well. So that's just my view on it. Of course, the costs will still be lower for the huge lump sum that you invested, and yeah, you just have to live with it. Especially when you only have money available every month, you will have to pay the monthly costs of buying into the market. And then a last point where I'm going to make another video about. So when you do CCA, you are always going to seem like you are underperforming the market. Because as you keep buying more as the market is running up and up, you are averaging up your average buying price. And every time when you open your app, you will see, I have, for example, you invest 200 Swiss francs every month, and after 1 year, you have 200 Swiss francs of profit. That's a really nice profit. But because the month after it, you add 200 Swiss francs more, your profit isn't going to go up suddenly with 20 Swiss francs as well. You just put in 200 Swiss francs that you invested into a stock or in an ETF. That ETF hasn't moved, so your percentage that the app is showing you is going to go down. So because the 200 Swiss francs of profit is going to be less compared to the total amount invested. And that's really a thing that you should keep in the back of your head when you hear then the performance of the SME or the Eurostox 600 or the Nasdaq 100 or the S&P 500. That performance is the performance of the year for those indexes. And that doesn't take into account the additions of money during the year that you did. So when the market goes up 20%, yeah, you will have a performance of 13%, more or less, compared to the 20%. And then, in fact, when you look at it the correct way, your performance is 20% as well. But because you averaged up your price, it seems on your app that you only had a return of 13%. And then you may think, hey man, CCA doesn't work. I'm running behind on the market. No, that's not true. It is just the way the app is calculating things wrongly for you. And then you have the positive points. So you reduce the risk of timing the market. And as you know, time in the market beats timing the market. And you spread out the purchases over time. So I prefer that. And it's reducing the risk of investing everything at the peak. So yeah, the peak was just before Trump announced the tariffs. Now we are back at the peak territory. So maybe now something else is going to happen. You never know. But I already mentioned it that in the previous slide, the last negative point. So it can seem negative in rising markets because you are averaging up your average buying price, but it can be positive in dropping markets. So when the market is going down, you are averaging down your price, and then it seems that you are performing better than the market. And in times when the market is crashing, this can give you an extra edge in keep going compared to other people that only see the negative numbers going down and down and down more. With you, it is it is slowing down the the dropping of your portfolio, so that can make the difference of you keep going with your investment or not. And this smooths down the volatility as well. So for some people, this is a positive thing. For me, it doesn't really matter because I know what is behind it. And it also minimizes the risk of you doing emotional investing. So you just do it every month, no matter what the sentiment on the stock market is. So you don't care about the fear on the market, you don't care about the greed on the market, you just do it every month. And it's a really accessible way of investing for beginners because you can start with 100 Swiss francs every month, 200 Swiss francs every month. And that's what I'm trying to prove with my U portfolio, that you can start with a low amount and build up a nice portfolio and have nice performances as well. And the most important thing is you have to keep it up. So you need to stick to it even after you think you outgrew the beginner status. And that's a trap for many starters. They have experience, then they see that they are underperforming, or they think they are underperforming the market, and they think that they have to change their plan, their strategy. But that's not really the case. You need to have a plan or strategy, investment strategy that is solid. So you need to follow that investment strategy for years and years, because that is going to make the difference in the long run. And I know that it is boring. So because actually the most of the work is actually happening before you start CCAing into the market. So before you do that, you need to make the plan, and you need to make the investment strategy for you. You need to do the budgeting as well. And yeah, it can be discouraging and tempting to switch to another strategy, but it brings along costs, and it's an annoying thing that some apps don't show your total returns as well. So when you are a dividend investor, don't forget that your dividends do count and do make a difference in the long run as well. So that's the biggest problem that I have with GetQueen, that they only show the performance of your stocks and your ETFs as you buy them, and then you have the price of now, and they look at the difference. But all the dividends that are being paid out, they don't take that into account. And I really hate that. You only have one place in GetQueen where you see your total return, and that is on the pie diagram symbol. You need to press that. You have to scroll down a bit, and then you see total return, and there your return includes the dividends as well. But they don't give a percentage. They when you want to see your performance, then you need to pay for the app, and yeah, that's a bit a damage. It's a pity. I think that they don't give that information to investors, especially dividend investors. And that's why I love dividends when I do CCA, because they help to visualize the progress. So the progress of your dividends received, that's way less volatile than the worth of your portfolio. So normally, at least, because it can be that when you invest in individual stocks and one of your stocks in the beginning stops with paying dividends, that your dividend payments go down. But with investing in ETFs, there you already have a diversification. And if one of the 100 stocks stops paying a dividend and the other dividend companies, they rise their dividend, normally the impact will be minimal. So normally the progress of your dividend projections are less volatile, and that's a thing that many people forget. It's a psychological thing. And you know my rule of 300. So when you invest 300 Swiss francs in a dividend paying ETF that pays 4%, that means that you will receive 1 Swiss franc every month. And I made a calculation without growth of the ETF, so everything stays the same. Normally your ETFs will grow over time. I know that for the past 10 years, dividend ETF didn't perform that great, but it's an exceptional time where informatics are really outperforming the market. So it's from 2008, 2010 on until now, 2025, that the IT businesses are outperforming the market. And yeah, dividend investing wasn't really in 2024. Suddenly it started changing, so I'm really happy about that. And if you look at my calculations, I would be I'm going to show the graph in the next slide. So without reinvestment of the dividends, it takes 300 months. So investing 300 times 300 Swiss francs in order to reach 300 Swiss francs per month in dividends. That's clear, because 300 Swiss francs gives you 1 Swiss francs a month. So after investing 300 Swiss francs for 300 months, you will have 300 Swiss francs per month in dividends. But if you reinvest your dividends, so every time when you have 300 Swiss francs gathered up in in dividends, you also invest those that month. So in those months you invest 600 Swiss francs. It takes 17 years and 5 months, so 209 months to reach 300 Swiss francs per month in dividends. So this means that you have 7 years and 7 months knocked off the total of needed to invest to reach 300 Swiss francs per month. If you also take into account a growth of your investments of around 5% and a dividend CAGR of 4 or 5% as well, it's going to be even faster, but that's more of a speculation type of thing. This is just pure calculation based thing, and I need to make a video about backtesting as well one day, but that's a complicated video to make. And for me, knowing that reinvesting my dividends, it helps me to stay consistent. Also, the fact that my dividends most of the time go up. So until now, from 2016 up till now, I have 5 months in which my dividend went down, and thereafter they went up again. So it's way more pleasant to see that graph than seeing the graph of my portfolio worth going up and down like crazy every day, in fact. But I'm not you, and you are not me, and you are also not in the same situation as me. So I have my age. I'm 44. I have a wife. I have 3 kids. I work here in Switzerland. Switzerland is really expensive, so budgeting is really important. I need to take into account as well that my pension in Belgium is going down and down and down because of the changes that the government is making there to the pension calculation rules. So for me, it's important to reach a certain amount of dividends per month. So I'm working towards that, and my wife, she supports me in that, and she also likes seeing our dividend received every month going up and up and up. And it just takes a lot of time. So you need to keep that in mind, and not being discouraged is really key. And remember that compound interest will work its magic over time. So if you look at this graph, I will say this number here, after 120 months, you have 120 Swiss francs that you will receive in dividends every month, but it will be 147 Swiss francs that you will receive with reinvesting. So it's only 27 Swiss francs difference on that moment. So after 10 years, that's not a big difference. So a lot of people will be laughing at you at that time. After 10 years, they will say, you with your stupid dividends and reinvesting them, it doesn't bring you a thing. And in the period before those 10 years, it's really tempting to change your strategy. I see it happening with a lot of YouTubers as well. They start with a dividend investing strategy, and people on their comments say, hey, you should have invested in Nvidia and blah, 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 blah. That's true. Nvidia went up like crazy, but it has to do with risks. So Nvidia, it's a risky investment from the moment that it doesn't reaches its values, its revenues, with such an high PE valuation. This means that when the revenue isn't there and the profit isn't there anymore, because now they are just really lucky, they are around for a long, long time, and now the AI business is booming, and they are right on top of it. So it's really nice for the people that are invested in it, that it is performing the way it is. But the moment that it stops, the PE value is going to go down from 57, 60, is going to drop to 30, 24, 20, 18. and then with lower profit margins as well. Man, those the people that are going to get out of it too late, they are going to lose a lot of money. So, and that's just what I'm saying. So just be careful when you are investing in Nvidia, get out on time. It's it can go on for 2-3 years more because AI is it's going to be the future for sure. But yeah, it's for me, I wouldn't be able to sleep at night when I have invested a lot of money into Nvidia. I'm exposed to Nvidia because I invest in ETFs that have it in their portfolio, but that's okay with me. It's really spread out for me. But for some people, they are really exposed to Nvidia like crazy, and that's just not for me. But here, after 300 months, you see the difference already. 300 Swiss francs per month you will receive in dividends with the normal strategy, and with reinvesting your dividends, you will have already 513 Swiss francs. And just remember, you are reinvesting this as well. So every 2 months, you will be able to invest 600 Swiss francs more. Even here, you will be able to invest 600, 600, 600, and then again 300 more every month. So you are increasing your worth of your portfolio like crazy as well. So reinvesting is key. So I would always advise to reinvest your dividends as long as you don't need them to live off for when you are retired or something like that. And the turnaround point for me when your dividend investing journey really starts is after the fact that you receive the same amount as with which you are starting to invest. So you start invest with 300 Swiss francs per month, and then at 209 months you receive 300 Swiss francs per month. So in fact, from that moment on, you can double your investment amount every month because you receive the 300 Swiss francs from your investment yourself. And that's really the time when your investment journey is reaping the benefits of staying consistent. You see a lot of videos on YouTube about 100k, and that's all bullshit. 10k, it's all bullshit. It has to do with, for me, when you receive the same amount of dividend of the amount that you started investing with. So for me, I'm almost there with 300 Swiss francs per month, but I increased now to 900 Swiss francs per month, putting it towards the ETF portfolio. But when I will see 300 Swiss francs per month, I will think back of 2016 and when we started this journey and think, man, now my portfolio is already, or our portfolio is already spouting out 300 Swiss francs per month. And that's the amount that we started with way back in the days. So keep at it and the results will follow. And I know it is boring, but you need to celebrate your milestones. That's also a dividend investing rule for that I gave in that video that I shared almost more than a year ago for sure. And so when you reach 100 Swiss francs per year, celebrate it. When you reach 365 Swiss francs per year, that means 1 Swiss francs per day, celebrate it. You have so many milestones that you can put where you are going to celebrate. So I stopped drinking Coca-Cola because yeah, it's not that healthy, of course, but when we reach a milestone, I go and buy a bottle of Coca-Cola and then I drink some glasses of Coca-Cola. That's a really inexpensive way to celebrate it, but for me it's a really nice celebration because I really like Coca-Cola, but yeah, I try to drink less of it. And yeah, how do you say it? Um, Obliging myself to only drink cola when I reach a new milestone. That's already helping a lot. So with that being said, thank you for watching to this one. Please consider subscribing to my YouTube channel. Hitting that like button helps out the channel enormously as well. So if you would like to do that as well, thank you very much for that. And with that, thank you for watching to this one and see you on the next one for my on my YouTube channel. Bye.